In today's discussion, we're going to be diving deep into QML trading. We have already discussed on previous video, but on this video, what we're going to do is to blend smart money trading concept or institutional trading concept, which is the same concept, okay? It's either smart money or institutional trading concept, whatever you call it. So we're going to blend it together with the QML trading concept. This is the main purpose of this video here. So you can see that I've indicated this as our low here, and then let me just indicate this level here, which is our lower low. So this level here, it's gonna be our lower low, and then this is gonna be our low, and then this is our high, and this is our higher high. Okay, so if you look at these, then it qualifies to be a QML structure. Okay, so this is gonna be our QML level. Okay, so it means when price get to this level of our QML here, we anticipate to see a sell. Okay, so you can see price got to this level of our QML here, and then we got to see a sell. Okay, so but if you get to look at this level here, you can see that when price get to this level here, we have a fair value gap here, and then if you look at this here, we have this high here. Okay, so we have this high here, and then we have this lower high here. Okay, so looking at this high here, you can see that we have an order block here. Okay, these are order block candle here. Okay, so an order block, it's gonna be the last up candle that formed the highest high prior to the down move. Okay, so if you look at this high here, the last up candle that formed the highest high, it's gonna be this one, not this one. Therefore, this is an order block, not this one. Okay, so we have an order block here at this level lining up with our QML level. Okay, and then we say then order block without a fair value gap. Okay, it's invalid. Okay, it's not tradable because it doesn't have high probability chances of being successful. So what validates an order block? It's a fair value gap. Okay, so you can see here we have a fair value gap here, and we have a order block at this level here. But if you look interestingly, you can see here, if you have noticed, you can see that we also have a fair value gap here. If you look at this and you look at this here, okay, you can see that we have a fair value gap here. But why didn't I choose this fair value gap here? Why did I choose this fair value gap here? It's simple. If you pull your fib from here, okay, you mark your fib from this range here and to this low here. Okay, so if you mark this range here that we are working within, if you mark this range here, you can see that we have our equilibrium at this level here. When we are talking about equilibrium, we are talking about 50% level of your Fibonacci. Okay, so that's 50% level of your Fibonacci here. These are just my modification, but this is just 50% of your Fibonacci. Okay, so the QML that you're gonna be taking, or the QML that you're gonna be trading, if you are looking for sell position, it's gonna be the QML that it's above your equilibrium. Okay, so if you are looking for sell position, it's gonna be the QML that it's above, okay, your equilibrium level, which is our premium level. Okay, so hence that's the reason why this was not taken. Okay, because if you want to sell, you want to sell at higher prices. Okay, so it has to be above equilibrium. And if maybe let's take you want to buy a discount, meaning below equilibrium. Okay, so above equilibrium, this is gonna be the fair value gap that we're gonna be taking. Okay, any fair value gap below equilibrium, it's not going to be the fair value gap that we're going to be interested in taking. Okay, so this is how I get to do it, to select my fair value gap. So the same is true in opposite. So let me just remove this now. I believe we are done with this. So you can see here, let me remove this. So you can see here we have a fair value gap at this level here, and we have an order block, and we have a QML level lining up with our order block. So there is high confluence at this level here, so price is most likely to be successful going down when it gets to this level here. So you can see price gets to this level here, and then it quickly went down. Okay, so there is something that I want you to notice. Okay, when price pushed down to form this lower low here. Okay, so now let's look at this level here. You can see I've indicated SMS. Okay, so this SMS is simply stands for shift in market structure. Okay, so you can see here the rally for this upward move, this sharp run upward. Okay, before we get to have the higher high here, you can see that we have this rally up, and then all of a sudden price came down. Okay, when price come down, we can see that this level here has been taken out. Okay, which indicates now what we call a shift in market structure, meaning price is most likely to continue to go down, or we are in a bearish market. Okay, since price broke structure. Okay, so it simply means price is most likely to change direction, or price has now changed direction since it broke structure. Okay, because when price is going up in forex, we believe when price is going up, it doesn't need to come for the lower low. Instead, it needs to come for the highs. Okay, so it needs to come for the highs and keep on forming higher highs when it's going up. Okay, so the moment we see price breaking this low and creating a lower low, we call that a shift in market structure, because price has indicated that the market structure is now going down. Okay, so hence that's why you see SMS here. Also, I want you to pick something here. You can see something. If you just look at here, you can see. Let's just look here. Look at this candle here, and then we go also to this here, and then you get to go here. Okay, so you can see that they have something in common. Okay, they have these long range candle that are creating price imbalance. Okay, so whenever we get to see this long range candle here, price is most likely to come back and close that imbalance. Okay, so these ranges, I mean, these long range areas, we call them liquidity void or just void. Okay, so that's what they call liquidity void or void. Okay, so merely this is simply price imbalance. Okay, so you can see here price is not consolidating, price is not consolidating, price is not coming back to close any gap, it just moves straight away. Okay, so this is what we have here. So if you see here, after we have this long range candle, you get to see that our price is moving up. Okay, retracing, okay, into this level of our order block or our institutional reference point, which in this case it's going to be our fair value gap and order block plus the QML level that we have identified. So as price is pushing up, we can see that it's now compressing. Okay, so price is moving upwards in a compressive way. Okay, so you can see here there is compression. So whenever we get to see a compression in price, is most likely to be followed by a shoot. Okay, so you can see price is compressing to get to this level, followed by a shoot. You can see price is compressing to get to this level, followed by a shoot. Okay, so whenever you see compression in price, it simply indicates that price is approaching a significant level, or it's moving towards a significant level. And then once you see compression like this, just look ahead and see what you have. Okay, if you have any significant level that you can use as a point to go short. Okay, so you can see here we have a fair value gap, we have an order block, and we have our QML level here. So price gets to this level here, and then we get to see a drop in price. Okay, so you can see here we also have the same thing here. We have a fair value gap here, and then we have an order block at this level here. Okay, I didn't pick this candle here, I chose this candle as our order block. Okay, so let me just explain. So the reason I picked this candle, if you look at this candle, we are on a daily time frame right now, and you look at this candle here, it represents 1 day. Okay, so you look at this green candle here, it represents the second day. Okay, so since these two candles, they are all green, we can agree that this can be one candle in 2 days. Okay, if we're gonna have a 2 day time frame, this is gonna be one candle, hence that's why this is the beginning of your order block. Okay, so this is an order block here, so that's why I mark it as an order block. And you can see the order block has a fair value gap here, so these now qualify to be something that you can trade. Okay, so this qualify to be something that you can trade here. So price push up and it gets to this level here. Guess what price does? It push down quickly, and when it push down quickly, it collects this sell side liquidity here, or these relative equal lows here. Okay, so it collects them, and then after some time we see compression kicking in. It comes back to this level of our fair value gap here with our order block. Okay, so it flows into this level of our fair value gap, and then we get to see a drop in price. Okay, so these relative equal lows that we have here, which is whenever we have relative equal lows, we say it's an area of high liquidity pools. Okay, so whenever we get to talk about liquidity pools, we are talking about an area where there is liquidity. Okay, where there is liquidity. So in that area, what we are basically saying, we are saying price is most likely to get to that area and then collect those lows. Okay, so liquidity can be in a form of stop losses or some buy limit or some sell limit. Okay, it doesn't matter, whatever pending order that will be there in that area, it's gonna be liquidity pools or it's gonna be stop loss. Okay, so we know that there is a lot of activity on previous highs and previous lows in the forex market. That's where our stop loss is gonna be, that's where pending orders are gonna be. Some people, they're gonna put buy stops, some people they're gonna put sell stops. All those activities, they happened on highs and lows. Okay, so basically that's why we say it's an area of high liquidity pools. And the more you have equal highs, the more you have equal highs, the more there is liquidity pools. Okay, because we believe in support and resistance as retail traders, so they believe in support and resistance. So most traders, they're gonna be comfortable in putting their stop loss here. Okay, believing that this is an area of high resistance. Okay, because they believe that when price gets to this level here, it won't break this level here, it will just push up. Okay, so you can see here, this is what happened here. Price gets to this level here, it creates this relative equal lows here, and then later it comes down, take out everything here. Okay, so if you look at here, let me just show you something here. So if you look at this structure here, if you are familiar with a breaker, so you can see we have this high here, we have this low, and then we have this high. This is a QML. This is a QML structure, but at the same time also a QML structure is no different with the breaker structure. The only difference is where we target our entry. Okay, so a QML and a breaker structure, it's gonna be the same structure. The only thing is the difference on where we target our entry. Okay, so when we are talking about a breaker, we target our entry on this level here. So we target our breaker, we target our entry on this level here, on this low here that is gonna be collected. Okay, on this low that has been violated here as a breaker structure, that's where we put our limits or our pending orders to sell short or to buy, but in this case it's gonna be a sell position. Okay, so price gets to this level here, it pushed down a little bit, and after pushing down it went up a little bit. So this is a QML structure also. So what you find in a QML, it's what we call an FTR. Okay, call an FTR. So an FTR simply stands for failure to retest or failure to return. Okay, so an FTR is caused by this breaker level most of the time in a QML. Okay, so you can see here, this is an FTR caused by this breaker structure here. Okay, so whenever you see the breaker structure, you get to know that you are most likely to have an FTR, okay, in your QML. So what we call an FTR here, the reason it's an FTR, I mean, it's because price got to this level here and we were expecting price to get to this level of our QML and order block and fair value gap. But for some reason, due to this breaker here, price failed to get to this level here. So we say that price has failed to return to this significant level that we are expecting, or price has failed to retest this level here. Hence, that's why we say it's an FTR. Okay. So another thing that we need to know, whenever you get to your entry here, let's say you make your entry here, okay, so you're gonna target this low to be taken out, okay, but one thing that you need to keep in mind is that price has a tendency not to take out this low here, okay, and just get to these wicks here and then turn around, okay. So that's what we call a rejection block, okay. These wicks here, we call them a rejection block, okay, meaning price will get to this level here and then you get to see it not wanting to close below this level here, okay. It will just keep on spiking this level here. You can see here it keeps on spiking this level and then it quickly move away from that level. Hence, that's why whenever you get to put your target, okay, so this is the tip, whenever you get to put your target, make sure that you, let me use this one, whenever you get to put your target, make sure you use the body of the candle, okay. So make sure you use the body of the candle, okay, because price has a tendency to get to these wicks here, which we call rejection blocks, to get to this wick here and then retrace, okay. So you're gonna be putting your TP here and then price doesn't get to hit your TP. So to be safe, always whenever you do your TP, your take profit, TP is take profit for those of you who are new, whenever you do your take profit, make sure you put your take profit here, okay. And also the same thing, if you just look at here, you can see price, it's simply doing the same thing here. You can see price is doing the same thing here. Just get on these wicks and then it just change direction. It doesn't take it out. So imagine if you put your stop loss here, you find that a price that doesn't even take out your, I mean price doesn't take your take profit and then it changes direction. So to be safe, just put your take profit here, okay. On these bodies of this candle, you put your take profit. So that's the same thing that you get to see here. We have price imbalances. Price was going down. We have this low being taken out here. We can say we have a shift in market structure. Again here, there's a shift in market structure here. Price push down, shift in market structure, and then price pull back to this level of our fair value gap here. Close the fair value gap, and then we get to see price pushing down. Okay, so I believe I've covered everything. If there is anything that I've not covered, please let me know and I'll make a video addressing it. Shalom.